What's up, everyone? Mark Zandi of Moody's Analytics has been consistent in his very conservative forecast for the future of the housing market. Even a few months ago, when Zillow and Redfin and CoreLogic and others were predicting price appreciation in the next year, Zandi had said even back then that he thought prices were going to be down to 0 by this time next year. And this was a few months ago. Since then, he's forecasted a 0 to 5% price drop in some markets, while in others he said a 5 to 10% price drop. Well, today I'm here to tell you that Moody's Analytics is slashing its home price forecast once again. Now they're forecasting a peak to trail U.S. home price decline of 10%. But this is based on no recession. If a recession does happen, then Moody's Analytics is predicting a peak to trail U.S. home price decline of 15 to 20%. Today we're going to go through an article written by Lance Lambert for Fortune that goes through this new forecast by Moody's Analytics, and we'll see which markets they think are going to get hit the hardest and when this is going to happen. Then we'll see if Redfin's latest forecast agrees with them and what the current status of our housing market is and the trends moving forward. So let's dive right in. Affordability has evaporated, and with that, housing demand. Mark Zandi, the chief economist for Moody's Analytics, told Fortune, prices feel a lot less sticky right now than they have historically. It goes back to the fact that they ran up so quickly during the pandemic, and sellers are willing to cut their price here rapidly to try and close a deal. Take a look at this map provided by Lambert and Moody's Analytics, which shows which regional markets are overvalued or undervalued here in 2022. You can see there is a wide range of areas that are considered either overvalued or undervalued. There are only a few areas that are considered undervalued, the ones in blue. I can see San Francisco, California, Bloomington, Illinois, Montgomery, Alabama, and Fairbanks, Alaska. You may be surprised by San Francisco. I definitely was at first until I read the footnote at the bottom that says if a housing market has a negative percentage, it means home prices are lower than expected when factoring in local income. So I'm assuming that the local income for San Francisco is quite high. They've given my area, the DC area, an overvalued rating of 28.51, which seems about right if I look at the recent comps from the spring market of 2022 when everything was selling way over asking. The more significantly overvalued housing markets, those that are overvalued by more than 25%, include 210 markets, with Boise, which is overvalued by 77%, Flagstaff, Arizona, 66%, Austin, Texas, 61%, and Las Vegas, 60%, leading the pack. Lambert writes that in significantly overvalued housing markets, Moody's Analytics now forecasts that home prices will fall 15 to 20%. If a recession hits, Moody's Analytics expects that U.S. home price decline to widen to 25 to 30% in significantly overvalued housing markets. Just to give you some context, in the Great Recession, home values fell 27% between 2006 and 2012. And as we know, when a housing market enters a downturn, the most bubbly markets fall the hardest and the fastest. These bubbly markets were just created during the pandemic housing boom, which is why the ongoing housing downturn has triggered price corrections so quickly. In this article, Lambert goes on to show that in 2019, Moody's Analytics deemed only 3 regional housing markets as significantly overvalued. They were Boise City, Idaho, Kennewick, Richland, Washington, and Sherman, Denison, Texas. Today, post-pandemic housing boom, they deem 210 regional housing markets significantly overvalued. So there are many housing markets that are going to see some serious price declines. As of right now, the biggest bubbly markets that are seeing these price corrections are Austin, where home values fell 7.4% between May and August, Boise, which is down 5.3%, and Phoenix, which is down 4.4%. And as for interest rates, Mark Zandi expects mortgage rates to be right around 6.5% for the next 6 months. That's up from his previous outlook of 5.5%. As long as mortgage rates remain that high, Zandi says it will apply immense downward pressure on those overvalued home prices. prices. Let's pivot over to Redfin's latest housing market update to see what they're saying about interest rates and the state of the current housing market. Mortgage rates well over 6% are spooking home buyers, said Redfin Deputy Chief Economist Taylor Marr. Sellers are pulling back in this market, but buyers are pulling back even more. It will take a few months before the prices of closed sales start to reflect this shock to the market. Home buyers have lost 29% of their purchasing power since rates were at their lowest in January of 2021. Take a look at this chart, which assumes a $2,500 a month budget with 20% down payments, annual property tax of 1.25%, and annual insurance of 0.5% of the purchase price. At the beginning of 2021, with an interest rate of 2.65%, this buyer could afford to buy a house for $533,955. Today, with an interest rate of 6.6%, that same buyer can afford to buy a house for $379,825. That's simply crazy. That's a huge, huge difference. Other statistics that cover the 4-week period ending October 2nd are active listings. The number of homes for sale listed at any point during the period fell 1% from the prior 4-week period. On a year-over-year basis, they rose 3%. So although inventory is up from a year ago, it's down from a month ago. New listings of homes for sale were down 18% from a year earlier. This is most likely due to sellers not wanting to trade in their low interest rate to buy a new house with a higher interest rate. Pending home sales were down 25% year over year, the largest decline since May of 2020. So less homes are going under contract. Buyer demand is down due to high interest rates and housing still being simply unaffordable. Homes that sold were on the market for a median of 32 days, up a full week from 25 days a year earlier, and the record low of 17 days set in May and early June. Well, this makes sense as well since buyer demand is down. On average, 7.7% of homes for sale each week had a price drop, a record high up from 3.9% a year earlier. Although this is nearly doubled since this time last year, I'm still surprised this number isn't bigger. It will be interesting to see if this number continues to grow and by how much in the next couple weeks. Months of supply, a measure of the balance between supply and demand, calculated by dividing the number of active listings by closed sales, increased to 3.2 months of supply, the highest level since July of 2020. Although this is higher, 3.2 months of supply is still a very low number. Traditionally, they say that between 5 and 6 months of housing supply is a balanced market. More than that would be a buyer's market, and less than that would be a seller's market. That's not always true. You can see here in 2019, we were at 3 months of supply then as well. 31% of homes sold above list price, down from 45% a year earlier, and the lowest level since February 2021. This number is actually based on houses that went under contract 30 to 45 days ago, so there's a lag time built in, so we'll have to see about today's market 30 to 45 days from now. That being said, I'm still seeing multiple offers and escalating prices here in the DC area. What about where you guys are? Are you still seeing multiple offers? Have you seen a lot more inventory come on the market? Have you seen a lot of price reductions, or are sellers still being unrealistic? Please definitely comment below so we see what's happening in real time by you guys in your areas of the country. Hope you got some value out of today's video. It's a lot of work, but I really think it's important to bring you guys the most up-to-date information so you can make the best decisions for you and your family. If you'd like to show our channel some support, definitely smash that like button, comment below, and subscribe to our channel. It helps us with the YouTube algorithm and just motivates us to make more videos. And if you want to see some other industry insiders' opinions, definitely check out these next 2 videos on the housing market and different updates and different forecasts. Thanks for watching. I do appreciate it. Bye!